So let's talk about something that might sound boring, but is actually really important if you have a retirement account. It's something called a Required Minimum Distribution, or RMD. Yeah, now you might be thinking, that sounds like some kind of complicated IRS thing, and well, it kind of is. But I promise it's not as scary as it sounds. Here's the basic idea. When you save for retirement using certain accounts like a traditional IRA or a 401k, the money you put in usually goes in before taxes. That's a good thing while you're working because it lowers your taxable income. Your money also grows tax deferred, which means you're not paying taxes on investment gains each year. But at some point, the government wants to collect those taxes. That's where RMDs come in. An RMD is the minimum amount of money you must take out of those retirement accounts each year once you reach a certain age. In 2025, if you turn 73, that means it's your first year where you'll need to take out an RMD. The government gives you a little time, so your first withdrawal isn't actually due until April 1st of the next year, so 2026. But after that, you'll have to take your distribution every year by December 31st. You might be wondering, why do I have to take money out? Can't I just leave it in there to grow? Totally understandable question. The truth is, the IRS let you avoid taxes for years while your investment grew. And now you're getting older. They want to start collecting taxes on that money. That's the whole point of the RMD, to make sure you're eventually taxed on that retirement income. Now, how do they figure out how much you have to take out? It's based on how much money you had in your account at the end of the previous year, and a number the IRS assigns based on your age. So it's not a random guess. There's a formula. For example, if you had $100,000 in your account at the end of 2024, and the IRS says your distribution factor is 26.5, then your required withdrawal for 2025 would be a little under $3,800. You can always take out more if you want, but you always have to take out the minimum. There's a big reason to pay attention to this. If you don't take your RMD, or you don't take out enough, you could get hit with a pretty steep penalty. The IRS can charge you 25% of the amount you were supposed to withdraw. That's a big bite. If you fix it quickly, they might reduce the penalty to 10%. But it's still better to avoid the problem in the first place. Some people like to delay their first RMD until April of the following year, which is allowed. But if you do that, you'll have to take 2 RMDs that year. One for the previous year and one for the current year. That could bump you into a higher tax bracket and increase your tax bill. So it's something to think about carefully. And by the way, this only applies to certain retirement accounts like IRAs, 401ks, 403bs, and similar plans. If you have a Roth IRA, good news. Roths don't have RMDs during your lifetime. That's one of the perks. So to sum it up, RMDs are just the IRS's way of making sure you start pulling money out of your tax-deferred retirement account and paying taxes on it. It's not a bad thing. It just means you're getting closer to using the money you've saved up for retirement. The key is to understand when you need to start, how much to take out, and to make sure you're on top of it so you don't get stuck with penalties. If you're unsure about any of it, it's worth asking a financial advisor or even your retirement plan provider. They can usually help calculate your RMD and make sure you're withdrawing the right amount at the right time. That's it for now. Thanks for watching. Please like and subscribe. I'll see you next time.